So what the investor can now do is say, let's take that lender who's willing to make a loan to this project, and instead of loaning it directly to the project, why don't we as the investor borrow that $7.2 million and we put in $2.8 million. And when the investor puts in that $2.8 million and combining it with the $7.2 million in the leverage loan, that fund has $10 million in cash. That $10 million in cash can now be contributed to the CDE as a qualified equity investment. And their $10 million contribution to the CDE still qualifies for $3.9 million in tax credits. So now the investor has put in $2.8 million of equity in exchange for $3.9 million of new market tax credits. So instead of paying $2.50 a credit, they are now paying 72 cents a credit. So the investor is getting their return on their investment, and the question is, how does the lender get their return on their investment? So the lenders put in 7.2 into the fund. The fund combines that with the $2.8 million of equity to make a $10 million qualified equity investment into the CDE. The CDE will then use those proceeds to make a qualified low-income community investment, or QLICI, into the qualified business at the bottom. They can be equity or loans. They can't be grants. For purposes of our discussion here today, what we typically see are loans. Well, those loans will have an interest rate associated with them. So the business will make interest payments back to the CDE. The CDE will then distribute that cash to the investment fund. The investment fund will then take that cash and pay the interest on the leveraged loan. So the leveraged lender here is still getting its return through its interest rate from the transaction, and the investor is getting its return on its investment through the tax credits. So both parties who come into this transaction from different perspectives, one from an economic perspective, which is the leverage lender, and one from a tax credit perspective, which is the investor, both are satisfied in making this investment. And so the leverage structure really allows you to bifurcate those two interests by allowing equity and debt to be combined to make a qualified equity investment.